The issue isn't that interest rates are high. The biggest change between then and now is the cost of housing. They've been telling us for 30 years that they won't need us anymore, and we're still here.
One piece of career advice, what would that be?
Look at what is the worst thing that can happen to you inside that loan. And there are people that have earned millions doing this. You have to really...
Hey, Ronnie, welcome to Business Klub. And we're doing a Business Klub small business podcast aimed at professionals and consultants like you. So we're very, very glad to have you here with us and look forward to having a great conversation.
I am looking forward to it as well, and I really appreciate the opportunity to do this with you. Can't tell you how much I've enjoyed being a part of the Business Klub.
Thank you so much. So the way it will work is that first we'll go a little bit deeper into your background, what your story has been, what have you done so far in life, and all those things, and then we'll deep dive into the world of mortgages and see. Ultimately, the objective is to help somebody who wants to get into your world. What are the steps that they need to go through, and maybe they can take a few nuggets from this conversation.
Well, that'll be great. I look forward to it.
Yep. So, tell me a little bit about your family and background.
Well, my background has been one of, and it spans along several decades, like 4 decades in this business. But
4 decades, wow.
Yeah, and my daughter believes I financed the pyramids. So, I have a 15-year-old who is kind of keeps me on my toes. We'll just
15-year-old, you look.
Yes.
You look very young.
And my 15-year-old keeps me on my toes. But I have been in this business for over 4 decades, and I have taken it upon myself to try to deep dive into my industry more than just being a loan officer or doing mortgages. I have kind of become an economics nerd around it. I am the past president of the Charlotte Economics Club. I was on their board as a treasurer for over 10 years. I'm past president of the Mortgage Bankers Association here locally and was the actual legislative chair for them for over 20 years.
Okay.
So I have tried to really not just be somebody who does this. I've tried to be somebody behind the scenes who understands it at a different level. And sometimes I have to be careful because I don't know if people want to know that much information.
Right.
I really don't.
Yeah.
And so that's kind of where I've come from in all these years in the industry. But I, like I said, I am a father of 2 kids who I'm very blessed to have in my life. And at this point in my life, it's been an amazing journey.
Awesome. How did you get started in this field?
Well, I saw that question. And I said, boy, that's a long time ago. That was 1982. And it was a friend of mine. I had moved over to Atlanta. I had been living in Birmingham for about 10 years, and I moved to Atlanta. And a friend of mine said, Ronnie, you're good with numbers. I think you might do this. And numbers is an important part of this business, but you want to know the more important part of this business is sales. Okay. Because it's important to know how to do the numbers,
right.
But the sales part of it was probably more important to learn than that, because if you don't get the people to bring you the loans, the other part of it doesn't really matter. And so I had to learn both sides of it. My first experience in business was as an auditor for like a 42 convenience store chains, like a 7-Eleven or something like that. So, that background gave me that side of it, but learning the sales side of it was certainly new and something I had to develop.
Oh, cool. So you said you started in 82 and we are in 2024. It's almost like 42 years of...
Yes, it is.
And what are some of the changes that you've seen happen in the market and in your business?
Well, what's really amazing is I don't know, Sudev, if you knew what rates were at that time, but mortgage rates were actually 15%.
15?
15 with a 1.5. The federal funds rate was 18. It was a very interesting time in the world, and we were coming out of what we're coming out of now, which was a very high inflation market. So that's why rates were so high. They were trying to tame that. The difference, though, and we were still doing some mortgages and people were still getting loans. The difference is the average cost of a house was $80,000.
Oh, okay. Yeah.
Okay. So prospectively speaking, it was a very, very different market from that aspect of it. So understand when people say, okay, 6% or 6.5%, and you think that's high, because we had this market where we had 2.5, 3, which was really an artificially induced market. But the issue isn't that interest rates are high. The issue, the biggest change between then and now is the cost of housing is much, much different.
So you end up paying more in terms of the interest.
Yeah.
Even though the percentage was lower, your absolute value is much higher.
Yes. So that's a good description of it. So that's a big change.
So you went from a loan officer, is that what you were before, and then to a mortgage broker?
Yeah, well, that's a recent change. I actually started as a mortgage broker for a company and went into what we called a more traditional mortgage banking. And everybody thinks of the bank as your mortgage company, but they're really not.
Right.
It is just one of
several functions that they do.
Yeah. I mean, you work for the bank. How many things do you guys do?
Exactly.
So what mortgage banking actually is that's all they do is mortgages. Right. But what they do is they do fund, underwrite, and then turn around and sell those loans back into the market. So, but that's all they do. And I was in that model for a long, long time. Because of what has happened over the last 3 years, kind of flipped my ideas on that and put me into the broker model.
Back.
Yes, put me back into it. And there's several reasons for it. One is I've never seen the kind of market we're currently in when it comes to rates. Okay. And I'm going to try not to get too deep into it, but the difference between what used to be to buy down a rate by, let's just say it was 7%, and you would take a half a point to buy down the rate, maybe an eighth or a quarter. Okay. And that's just how it worked for years and years and years. Now we're starting to see, go ahead.
Well, what do you mean by buying down?
Well, in other words, if you wanted to buy down your rate from, let's say it's 7% right now and it's no points, for example, and you wanted to buy it down, you would take you a half a discount point of whatever you were borrowing. And, if that's $100,000, well, that's $500 or whatever that case, just to break it down into those kind of things. But that's how you bought down rates. Okay. What I've seen in the last 2 years has been absolutely, unprecedented, because the difference between 7% and 6% might only be a discount point now.
Right.
I've never seen that before. Okay. And on the flip side of that, to back it up is the same thing. If you're trying to get premium pricing out of it or something to pay closing costs. And what has happened is that corporate models, well, it costs money to keep your corporation going, doesn't it?
Right, yeah.
Okay. So the corporate model was costing me anywhere from an additional point to my rates. Every day somebody come in and have a better rate to me because he was a broker, because he didn't have that corporate expense. And I went, well, wait a minute, I don't want to do that anymore. So I flipped to this broker model so that I can give my client the best rate possible and have 200 lenders to do. So that's why I went to the model, was for that delivery purpose.
Does that impact the take home or things that you were getting from a income perspective?
Yes, I basically am absolutely able to deliver a better rate to my client, to the customer, and my comp is better.
Okay.
So it was like, okay,
win-win,
it was a win-win for everybody. And even, I can control my comp. So if I need to compete a little more, I can.
So the earlier model you couldn't.
Yeah, yes, much more. And also having the ability to, I'm now able to do a lot more investment property type things. I have things like fix and flips, what we call a DSCR, which is just a mortgage that allows you to buy an investment property just using the rental income to cover the mortgage.
Oh, what does DSCR stand for?
Yeah, well, it's you were asked that. It's basically, and I'm trying to remember what it actually stands for, but it's basically a form of being able to cover your mortgage with the mortgage payment. Okay. And I'd have to look it up. I've looked it up and I still can't remember what it is, but and we'll get back to that.
We'll figure that out.
I'm trying to remember. About 3 minutes into this conversation, I'll remember it because that's the way my brain works now at my age.
That's all good. So you said you had 4 decades of experience, and in the business. What are some of the proudest moments and achievements that you've had for the last several years?
Well, I will tell you this. If I could tell you, as part of my industry is when you give back. I've built 4 habitat homes, for example. Okay. Those are what I consider some of my more prouder moments, because Habitat for Humanity, if you're familiar with it, is not really a home giveaway. It is someone who has they have to do over 300 hours of work on other homes, and then they get a 15-year mortgage that is interest free on that house, and they pay that back at that level. But building those houses was a very interesting experience. It also told me why I don't do contracting work. I put an entire roof on a house, and I'm literate from shoving the trusses up on it, putting everything on it. I remember I got up on Monday and thought somebody had beat me up, but that's some of my prouder moments. Being able to work with first-time home buyers, achieving people's dream of home ownership. That's one of the greatest things about our country, and what's kind of eluding us right now is that dream of home ownership and owning your own home, building equity in your home, And I have really, if you wanted to say what are the proudest moments, it's helping that first-time home buyer, achieve that, because I do something that a lot of people don't. Some people do, but most of them don't. Is I went to a lot of my closings, and personally went to the closing table and sat through the closing process with the borrower and the attorney and everyone to make sure that questions are answered. But just to let you know, I'm there for your support.
Right,
too,
right. It makes sense. Yeah.
You
have to have that personal
touch to it, and some of the most, like I said, greatest moments is watching the look on people's faces when they realize they own their own home. So I could tell you that's probably one of the more prouder moments of it. Of
course, yeah. To make a difference to the fellow human being. Yeah,
yes,
it's amazing.
And it is, and navigating these people through the process. Mortgage lending is very, very different than anything you do. And we went through an era that caused a lot of trouble, but we'll get into that in a little while. But we require different things than any other type of lending. We require a great deal of income documentation. You can't just tell me what you make. You got to prove what you make,
Right, yeah.
And, guiding people through this process, especially since the crash in 2009 and 10, that process became extremely arduous. All the guidelines really got tight. Maybe too tight, to be honest with you, because people talk about foreclosures and stuff right now. We're at the lowest foreclosure rate in the history of our industry right now.
I read that somewhere.
Yes, we are, and we got so tight that we didn't. Normally you might have a 2% delinquency rate. We're way below 1%.
Why do you think that has changed?
Well, because of the guidelines that we have. I mean, there were actual things written into the law. If you're familiar with Dodd-Frank,
Dodd-Frank,
they wrote some very specific things. It's called the ATR, which is the ability to repay. And if you don't actually, as a lender, cannot document that person had the ability to repay, they can sue you.
Oh, really?
Yes. Wow, okay. So when you start having to have that kind of responsibility inside a loan, you start to look at it very differently, don't you?
Oh, interesting.
Yeah.
So I've been trying to look for some foreclosure properties, but I can't find that easily.
It's very difficult, very, very difficult, because there's 2 things going on. One is the value of homes has risen so quickly. So if you're in trouble on your loan, you just sell it and walk away,
right.
Make some money on it. Yeah. If you get foreclosed on, usually right now it's because it's and I hate to say this, but it's usually some kind of a divorce situation, or someone has passed away and the family is fighting over the house and nobody's keeping. Those are the only foreclosures you're seeing pop up on the radar.
Okay.
There used to be a thing where HUD foreclosures, FHA, HUD foreclosures, you used to be able to go on there and there would be like pages of it. Well, you go onto that website now, and you could go right now onto the HUD foreclosure website, and if you find 10 in the entire state, you'd be lucky. And most of them are like, one might be in Lumberton or something,
Right.
some odd place like that. So it's that's kind of where we are in that world.
Cool. So digressing slight, I want to ask you, what skills do you think are necessary to become a mortgage broker, especially in such a competitive environment?
Well, that's a great question. What skills does it take? Well, first of all, you need to be able to understand sales, because it's about developing relationships. It's about being able to talk to people over the phone and being able to give them the confidence that you're the person to go with them. Okay. That is a very important skill. Wish I had learned that first, to be honest with you.
Right.
The relationship, I've always been more of a traditional, what they call traditional type. I'm not a call center guy. I've always gone out and sourced my own business through realtors and builders of that nature. So I think understanding how to develop relationships with your clients is important. But also just as important is understanding how to profile that borrower and understanding the guidelines of the products you offer. I mean, it is very critical in the market we are, because those aspects of understanding, everyone has a different credit profile. I'm going to tell you, it's like fingerprints.
Right.
Okay. Everyone's got a different profile.
Yep.
And I don't hope that's a correct word. Profiling used to be a bad word, but you really have to understand that side of it. And because what you don't want to do is get somebody into a process and realize, oh my gosh, they really don't fit this.
Right.
And you having to back up and put it somewhere else.
Yep.
And I've been caught in that situation myself, especially in the broker world, because believe it or not, I recently had a case where I presented, and this was a very strong case. I presented the same information to two different lenders, and one didn't want it and the other one took it in 6 days.
Oh.
And I'm like, okay, what's wrong with this 68% LTV, 780 credit score borrower? But that's how different lenders look at things. So understanding the products you have and where that client fits into it is immensely important.
Great. So how long do you think it takes from, say, someone who's a graduate, who just graduated, and he wants to get into being a mortgage broker, if you will? How long does it take, and how many months or years will I have to wait for his paycheck to come in?
Well, it's a good question. First of all, you don't have to be a graduate.
Okay.
That's the first thing I'm going to tell you.
Oh, that's cool.
You do not have to have a degree to be in this business.
Oh.
Okay.
You have to be good with the numbers and relationships.
Yes, it's about numbers and relationships, those kinds of skills. And I've seen people get in this business and become very successful within 6 months because they had the relationship skill and they had a team behind them, a group of people that could navigate while they learned the other side of it. Okay. And sometimes when people recognize that, they'll shoot you out there and say, get the people in here. We'll determine how we can put them in it, or if they can't be put in it. So that's how quickly you can ramp up. I always tell people this is a job where you can make $50,000 a year or $1 million a year. How many jobs have that kind of pay scale? I mean, I know, most of us in this industry, we're 6-figure earners. Where you fit into that low or high figures is, how much do you want to work? Because I will tell you this, I've known a lot of people that's all they do. I mean, it's 70, 80 hours a week, and they make a lot of money, and if that's what you want to do, you can do it.
Okay. So it's basically, it's what you decide where you want to put yourself in
it. It's exactly correct.
Okay.
It's a very unique industry from that standpoint. Like I said, we think that the world is all going into this digital world.
Right.
And that you can go online and do this and do that. But the reality of it is this industry still needs an expert on the other side to navigate people through it.
So if someone were to start, they start being your assistant, or how do they start?
Sometimes they start out as a processor. And the processor is the person that works in the back who after the loan officer or loan originator gets the deal and gathers, they assemble all those documents and send it to the underwriter. That's what that person does.
Right.
That's a great place to start, because now you understand how this works, and you're working directly with an underwriter, understanding how the to get the back end works. That's a really good place to start.
Okay.
And it really can give you, at some point, you have the ability then, as that part goes forward, you can go out into the sales side if you have the courage, because it takes courage, because this is a straight commission. It's a straight commission job, and so you have to understand that part of it.
So does the processor get paid a salary?
Most processors get paid a salary. The most interesting thing that I've gone to with this side of the business, the brokerage part of it, is now my processors are only paid when the loan closes. There is a charge for there's a processing fee on every loan. Now that just processing fee goes to that processor. We use contract people. So if you're with a traditional mortgage company, that processor is getting a salary. If you're with a broker, that processor's probably only gets paid. Okay. I'd rather have the processor that only gets paid when the loan closing.
Because then it's a win-win.
Yeah, it's a win-win for everybody.
Okay, that's cool. So when you are starting off as a mortgage broker, do you build relationship with other lenders? How do you do that, or is there like a portfolio?
Well, that's a good question. First of all, you have a lot of wholesale lenders today, and the reason you have that, and I don't know if you're familiar with a company called United Wholesale Mortgage, but the UWM is the largest, along with, who Rocket is. Everybody knows Rocket. Well, Rocket and UWM have been kind of battling with each other. The difference between Rocket and UWM is UWM is strictly a wholesale lender. But you begin to go there. More people are doing what we call broker, because you don't have to maintain the infrastructure of a retail outlet. So you develop that. But what I did is, there's a company that my company, Coast to Coast, is basically does all of our back end work as far as keeping us compliant with all the states and things of that nature. They have that side of it. And they have got all the lenders that we have inside of there. We get a lender list from our company. Right. And so basically there's like 200 people on it. Now, do you want to use 200 lenders? The answer is no. But if there's something that pops up on the radar, you come out of the box, we've got a lender that will do it. I got a lender right now that popped up that will do what we call a no ratio loan, which really surprised me. But basically, you're going to pay about 2 or 3 points over market, but you can get a loan without having to prove a lot of income inside of it. Okay. You just have to have assets.
Okay.
So there's a lot of
collateral based.
Yes. It's about, down payment, 20-25% down. And you have to have X amount of cash reserves.
Oh, okay. So when you say cash reserve, does that mean the 401k or?
No. It's how much, like, let's say your payment's $3,000 a month. Well, they want you to have 9 months cash reserves after the closing.
Oh, really?
Okay. Yeah. Wow. So that's what they're looking at, is your ability to maintain the mortgage after
plus 20-25% down payment.
Yes.
Okay, cool.
So you're not really doing risky stuff.
Yeah. Interesting. So shifting gears, let's talk a little bit about the industry trends. What have you seen of late with the mortgage rates rising? Are you closing many loans?
Well, you know what? Since I've gone to this model, I'm closing more loans. Okay. And because I'm more competitive. I worked for a traditional company. I went through it. If you want to talk about what the industry has gone through, I'll give you a great example of it. In 2023, in January 2023, the company I worked for got sold. Went to work for another one, they got sold. Went to work for another one, and they got sold. We got sold 3 times in 90 days.
90 days.
Okay. I didn't even know what system I was on. I mean, I would sit through a training class, and the next thing I know, I'd be sitting through another training class trying to figure out what operating system. Yeah. That's how chaotic our industry was in 2023. I mean, that's a really good example.
Because of the rise in
rates. Try to imagine this, Sadev. If your business loses 50% of their business in 6 months, okay, what kind of impact that has on you.
Well, it's almost no income, if you will.
It's basically, you either go out of business or you buy up the small guys if you have the cash. A lot of people, servicing is how a lot of companies survived. The servicing portfolios that they had. Some of them sold it, some of them had the income coming in from it. But if you didn't have either one of those, you pretty much either sold out or went out of business.
Cool. So you've seen a lot of technology advancements in the mortgage industry,
Yes.
With Rocket Mortgage, Quicken Loans, all these guys coming in. How has that impacted you as a mortgage broker, and what's your take on the technology advancements?
Well, can I tell you something?
Yeah.
We actually started using what you call AI in 1998.
98.
Yes.
Okay.
The dawn of automated underwriting systems using computers to analyze a person's credit portfolio. Okay. That was the actual dawn of our innovation into this industry. And it really changed the entire dynamic, because prior to that, we were on very strict guidelines of 28-36 ratios. And what I mean is 28% of your expense, your housing expense, based on your gross income. Okay. So if you had, let's just say you made $10,000 a year, well, your housing payment couldn't exceed 28% of that. And your total debts couldn't exceed 36%. Okay. Just to,
so that's the ratio that
those were the ratios.
Debt to income ratio.
That was it, man. And if you didn't fit in that box, you didn't get a house. Okay.
Wow.
I mean,
you just paid the rent.
You just paid the rent. If you couldn't make that, you finally had to make that cut.
Yeah.
Okay. When automated underwriting came along, it came on with entirely different models where we expanded those ratios, and it got a little crazy past 50 to 55%. Okay. So it really changed the dynamic of what we were able to do and the amount of loans we were able to do. And so we really were on the cutting edge of some of this technology. The technology that we have now is the streamlining of the processes of being able to use electronically, be able to verify your income through a database. Okay. If you're with a big employer, you plug in a number and it pulls in your income. If you give us the information, we can pull your bank statements through the system rather than using paper. Those are the kind of innovations you're seeing right now. And it does help streamline the process, but it doesn't make the process, it doesn't mean that your loan is any easier to get. It just allows us to reduce some of that
the turnaround time and
the ability
efficiency to process.
The efficiencies inside of it.
Okay, great. So a lot of fintech companies have come into being of late. In fact, some of the banks are becoming more fintech than it was ever before. What do you think are some alternate financing options that have come up recently? I know I recently discovered things like, of course, home equity line of credit was already there, but I also found that there's something called a home equity payment.
It's a home equity share.
And
that's been very interesting. And I'm actually doing one.
Okay, you do? Okay.
Yes. And what that is that is a company that will give you a percentage of whatever your house is. Most of them operate off of about 25% of whatever the current value of your home is, what they're willing to leverage. Okay. What they do is they give you that money based off of what they think your house will be worth in the future, and you have to give them a share of that equity in the future.
Same share. Okay.
Okay.
So does that? So do you don't pay interest or anything?
It's not an interest-driven thing. It's strictly now, and they're gambling. What if the market crashed or something like that? But they only operate. They don't operate in all markets. Charlotte is a market they will operate in, but it has no payments associated with it.
Wow.
Okay, so you have to calculate that into the equation. All right, whether it's a HELOC, you have a monthly payment. This has no monthly payments on it. So if I've had some, I actually got some clients into it. I have a ton of equity in my personal residence. I didn't need to access a lot of it, but I needed, I need to access some. I've got rental properties, just some things that need to get done during the off season.
Right,
they're beach properties. And I said, I've got $700,000 sitting here. I need, some of that. And so that was a great way of going into it. So an equity share isn't right for everybody, but you have to verse it against what you're trying to accomplish with it.
Right. Okay. So if you were an average borrower, would you recommend a HELOC? or a home equity share?
That is a good question, and it really has a lot to do with two things. One is right now, believe it or not, HELOCs. Now you can get some banks that will give you a year at a special interest rate, but it's still 3 over prime, and prime just went to 7 3/4. So when you think of prime plus 3, well, that's 10 3/4 right in there. Maybe you'll get a little bit better deal if you got really good credit, but you're still looking at those kind of rates for that. Okay. So you have to verse that against a home equity share. Do you have a situation where you're investing, like if you wanted to get some money out and buy an investment property, fix and flip or something like that, and you use the equity share program, you don't have a payment on it. So you're not having a cost of carry.
Yeah.
You go in there, you flip it out, and you come back in, and a year later you pay that off. You may pay an interest rate, but you're going to pay an interest rate anyway, one way or another.
Right.
But you don't have the burden of the payment to carry that money, and that's really important in that world.
It's basically, I would say, net present value of the money.
Yes,
and that's what you look at.
Yeah, that's a very, very good description of what they're doing.
Yeah. So, and how much does it cost you to? It's like an opportunity cost.
Yeah. Well, if you calculate what a payment would be on if you borrowed $100,000, okay, what's the value of not having to make a payment?
Yeah.
Okay. So you factor that into whatever you pay on the other side.
And you bet on the market going up, and then say, hey, I owe this much money. I'm okay to lose because, the market's gone up and there's nothing technically I'm losing right now.
Yep.
It's like paid forward kind of thing.
And once again, too, the longer you have it, the more it costs you. So, they actually go out to 10 years on most of them. Some of them even go 30, but which I find very interesting because these companies are putting money out there. They're not getting money back.
Yeah, for several years.
For several years. So it's a very interesting model.
So is this a new trend or has it been?
Very new. Very new. Last 2 years.
Oh, really?
Yes,
okay.
Last 2 years.
Why do you think that they started emerging?
Well, I'm going to tell you something. You're familiar. You're in the banking world. Yeah. Hedge funds and things of that nature have a lot of money cash to put out there. And they're looking at certain markets and saying, hey, I'm betting on us getting more of our money back than if we invested it in a traditional vehicle. But that's the only thing I can tell you from what I understand about it. And the other side of the market is what we call the non-qualified mortgage market. A qualified mortgage is considered one that goes to Fannie Mae, Freddie Mac, FHA, VA, those traditional markets. Those are the ones that are written into the Dodd-Frank bill. All right. The non-qualified market or the non-QM market is what was born after the crash, and it reorganized as a different animal. And it's had its moments over the last 5 years. There's been some really tricky times with it, but they have come in and kind of bridged a gap for the self-employed borrower who doesn't have that traditional tax return that's going to support what would normally do 12 months of bank statements. Okay. Being able to use P&L statements. Okay. Those are kind of products out there that have assisted those people that are not in that traditional bandwidth. And believe it or not, the rates are not that much above the traditional. You pay a little bit more and you have to have more money down, but not a lot.
Okay. So I know there are some programs for first-time buyers where you can do only like a 5% down.
Well, you can do as little as 3.5% down.
Is that
through FHA?
FHA, okay.
If you're a veteran, you can do 0 down through their program. And there are programs in rural areas called USDA where you can put no money down. You have to be outside of metropolitan areas, and they have a qualifying zone for
agricultural zone.
Agriculturals, but they're not agricultural loans.
Okay,
they're just in those kind of areas.
Zones. Okay.
Yes, those zones
outside the metropolitan.
Yes, if you went down below Rock Hill now, something like that. Yes.
Okay.
Go ahead.
Yeah. So my question to you that if I were I bought a new house and then I sold that house, but I'm buying for the second time, do I qualify for the FHA loan?
You do if you want it.
Oh, okay.
Okay, it's not a first-time home buyer program.
Oh, okay. It's
I
not
wouldn't
first.
recommend it if you had a lot of money down.
Okay, of course.
Because
but you're saving on the PMI or something.
Well, you have a more what we call upfront mortgage insurance that's financed into an FHA loan that is required whether you put 5% down, 3.5% down, or 20% down. You don't get any break from that. The only reason someone would use that is in a situation where you have low credit scores.
Oh, okay.
Okay. And it does work for those people. I've done a loan for a guy who was coming out of a divorce. Credit scores got pretty beat up, but he had $100,000 to put down on his house. And despite him having an under 600 credit score, I was able to get him a loan.
Oh, wow. Okay. So in those cases, these FHA loans, and that was like a second house or something. So there's no qualification that you have to be a first time.
No, not on an FHA. The only things that require to be considered first time home buyers are things such as down payment assistance programs. Okay, through North Carolina Housing, South Carolina Housing, all of those things have down payment assistance. Usually all of those have two things. They have income caps, and they have the first time home buyer cap where you cannot have owned, and that means you cannot have owned a home in the last 3 years. Okay, so it's not as restrictive as you might think.
Now, talking a little bit about the customer side of things, what are some of the misconceptions that people have about getting a mortgage?
Well, one of them is that you need 20% down, which you don't.
Which you don't.
That's a great, you kind of addressed that already. The other misconception is that somehow or other, you don't have to have a certain credit profile to necessarily get a loan. A lot of people come to me, and you do have to have a certain amount of credit to show for this. If you start getting below 620 credit scores, the options become very, very slim. Okay.
The cost of capital becomes
well, the cost of it, but the underwriting guidelines, all the things become much more harsh. All of those things go into play. But I think the lack of understanding of what kind of documentation that you need, because you can go down and buy a car, and you tell them how much you make, and if you hit a certain block, you walk out the car tomorrow. We require a great deal. We need to know where your funds are coming from. You have to provide us proof of your funds.
Right.
You have to be able to show documentation of your income. And those are the kinds of things that people are really not. And I'll be honest with you, underwriters ask questions that I go, why did you ask that? And people why do they want to know that? And I said, can you get it to me? And they said, well, yes. I said, well, then get it and don't worry about it, And I hate to use this example, but you know what the golden rule is?
No.
The man with the gold makes the rules. I mean, it's not my job. I don't make the guidelines. It's my job to help you navigate them through.
Okay.
I used to tell people, if you've heard of waterboarding, well, you might feel like that by the time I get through with you on this process.
Right.
I really try to prepare customers for what the process is, because sometimes to them it just gets real personal. I'll tell you where it really gets tricky is if you're getting gift funds from a relative. FHA and
there are limitations on the gift funds?
No, not limitations. It's the documentation you need to get from the donor that they start getting squirrely about. Why do you need my bank statement showing I had the money? FHA requires that we
AML money laundering
right.
rules. Okay.
Not only that, they want to know that whoever gave you that money was real. Okay. Because when you go back into loans that went into default that had gift funds, it was always something weird about where the gift funds come from.
The source of funds.
Yes, the source of the funds. So, when you're, and a lot of parents and a lot of people give their kids money to buy a home, but they get a little upset when we ask them for the, hey, show us where you got that money from. They don't like that. So
right. So leading from that, what are some of the red flags that, the customers must be aware of before getting into a mortgage? Any red flags that you can think of?
It's a good question, a red flag. I think really, I can't say from a customer standpoint, but, we as loan officers have to look for red flags with our clients, okay? that person is not, their red flags really can be about the house they're buying or something like that, where they're trying to buy something. There might be things that you really need to look at in the house itself, because that's where you can really get into issues.
Oh, the appraisal,
but just what's mechanically going on inside that house. Does it have, what kind of flaws it has? That's your realtor's job, to help the red flags on that side. We as lenders look for red flags for people trying to commit fraud with us.
Okay.
And believe it or not, we take courses on this. We have to take more courses on AML, anti-money laundering. So there's a real interesting thing. There's two things in housing. There's fraud for a home, and then there's fraud for profit. They're very two different things. One is somebody's committing fraud, falsifying income or something like that to be able to buy a home. And then there's the fraud where somebody is trying to buy a home to take the funds and run and kind of, scam the deal. So there's two different types of frauds in housing. Believe it or not, we still have problems with that, despite all of the filters that we have in it. A lot of people don't know we use things like Nexus, Lexus, and other companies like that. The databases that we use today, to every borrower we have, the underwriter has the database and says, they come back and say, well, this person's on title in a property in Ohio. Okay, the borrower never told me that, but we find these things out. Do you still own this house? Do you have any obligations to it? Is there a mortgage on it?
Right.
So there's a lot of things inside of us that we're people. You can't. I tell people all the time, you really can't hide anything from me. You can try, but we're going to find out.
You like the lawyer and the doctor?
Yes.
Just for the housing market.
Yes, it really is.
So, if somebody had a foreclosure or a bankruptcy in the past, will it be easier to get a loan?
Well, it's not easier, but there are timelines that you have to go through. Okay. If you've had a bankruptcy, FHA has a 2-year sentence. But if you've had a foreclosure, it's 3 years with FHA and actually 5 years with Fannie Mae. So those are the timelines you have to be able to.
So you have to just sit through it.
Yeah, you just have to sit it out. And I'll tell you where that really created a problem was when the crash took place back in 2010. The banks people walked away from their house in 2010.
Of course,
and they come to me in 2013, 14, or whatever, thinking they hadn't even been foreclosed on yet. The banks hadn't even gotten around to foreclosing on the property, but everybody just thought, since I sent the keys back, that's how far behind the system got back then.
Given your experience in the last 4 decades, is there anything that you wish you had known first in the beginning when you started, or could you have done anything differently so that your whole career would have been different?
Yeah, that's a really good question. I read that last night when you sent it to me, and I was trying to think through that one pretty well. I think I wish I had done a little bit more on the sales side of things before I got in it to understand it. And the other one was just, understanding the relationships that we have with our clients and learning some things. Because here's the one of the most important things is people's perceptions are their reality. And once you understand that, you can really navigate people a lot better. Because what they perceive is their reality. It may not be the truth, but you got to find out why they believe it.
Yes.
Before you can actually overcome the problem. I can sit here and argue with you all day long. It doesn't help me until I know why you think what you think.
Absolutely. And what are some of the, related to that, what are some of the valuable lessons that you've learned that you would ideally pass on to someone like, say, Aryan, who is maybe starting off as a mortgage specialist?
Well, I will tell you, that's another good question that I kind of pondered through the lessons. One of them is, and this is a very important lesson, there's a lot of people involved in the process of a loan.
Yeah.
You're the point person. Lesson number 1, you're the one that's going to get yelled at if something goes wrong.
Right.
Even
you're client facing.
Yes, you're the one facing the client through the whole process, understanding that it doesn't matter whose fault it is.
Right.
You're the one that's going to have to face that, and really understanding what the people behind you do. Okay. What is their capacity right now? you know, people say, well, can you close this loan tomorrow? I said, I don't close loans. I don't process or close loans. Let me call the person
who does it
and see if they can do it for you. Because the greatest lesson I learned is don't make promises that somebody else has to keep.
Yeah.
Until you know they can keep them. You know,
do only things that you can control.
Yes, stay in control of what you control, and make it very, very clear. Create the correct expectation through that process. Don't sugarcoat things, because everybody doesn't want it. You just can't, you know, because at the end, everybody, even if you close it, everybody's mad at you. And it's hard enough to get there through the correct process and not everybody be mad at you because of what they've been through. If you try to, avoid things, it just doesn't work.
Doesn't work. Slightly digressing, this is a question that came to my mind. It's not part of the thing that I gave you. There are a lot of bankers in Charlotte, of course. There's Truist, there's Wells Fargo, there's BOA, and there's Fifth Third, and a bunch of.
There's a lot of PNC. You got a ton of.
So now, and then there are mortgage brokers like you. Why would somebody go to? Why wouldn't someone go to, say, a traditional banker versus a mortgage broker like you?
Do you really want to hear the answer to that?
Yeah.
Okay. Well, first of all,
as candid as you can be.
I'm going to be very candid with you. A bank, everybody thinks, it's going to be easier at my bank. Well, guess what? Most of the time, it's really not.
Because of the process, bureaucratic.
The process. Plus, listen, how many customers does your bank have?
Right.
Millions?
Yeah.
Okay.
Yeah.
They make one person mad, it doesn't matter to them. Yeah. Okay. In my world, it is extremely important that everybody has the correct experience, because I don't get paid and I may not get another deal.
So you have that personal relationship.
But also it's all I do. So therefore I must do it better, because I don't have, all these other bank lines behind me that's going to keep my bottom line up. Okay. And I'm not saying that the banks don't like mortgages, but some of them don't. I mean, Bank of America and Wells Fargo, really, mortgage business hasn't treated them very well in the last few years. And there's reasons for that. It's not really their own fault. But there are reasons for it. They ebb and flow on how much they want. There was a time when Wells Fargo was one of the biggest powerhouses in the mortgage industry right here in Charlotte.
Okay.
And that has since gone. Okay. But you really want to work with someone that's their only source of what they do.
Because it's particular niche.
It's a niche, and it's what they do. And, the bank's got all my information. Yeah, well, that doesn't mean it gets to all the right people, the difference between me and where you might go to a bank is I can call my president on the phone. Okay.
Right. Yeah.
I don't know how many people you'd have to get through to get, you would never get to the president,
Right.
But there's none of the bureaucratic layers that you deal with. So from my perspective, the mortgage broker is going to work in your best interest if they're good at what they do. And they're going to try to maximize the ability to get you the very best rate that's available for your credit situation.
Awesome. So let me ask you that question a different way.
Okay.
So between the banks, why would you go to a TD bank versus why would you go to I know the answer has come to me because it's, we will serve you better. But, just between the banks, how would it be different?
Well, let me say this. The banks, to go to the bigger banks, and to be honest with you, and this is not nothing against anything, but if you're a high net worth borrower, the bank's going to treat you pretty well.
Okay.
Because what do they want? They want your other assets, and so they do offer some good jumbo rates. Okay.
What's a jumbo rate?
That's anything over the conforming loan limit. I think this year it's 800,000, which is Fannie Mae's conforming loan limit. So now it's anything over 800,000 now is considered what we call jumbo loans. The banks can offer better terms on things like construction loans, construction perm loans, things of that nature. Okay.
Would there be a difference in cost of capital, like the closing cost and things like that?
I don't think there's a whole lot of difference in the closing cost. I really don't. I just think that they cater to a different
Market
client,
segment,
you
okay.
know, clientele. It is to say that they don't want to treat I'll be honest with you, the credit unions are very competitive in that world.
Okay.
Okay. I tell people all the time, if you want a HELOC, sometimes a credit union is a better choice. They offer they offer some things that I don't. I said, where? No, I said, how can they do that? The banks can't even do that, sometimes. So, it just depends on what you're looking for.
Okay. Now, we have a few aggregators like lower.com or better.com. What's your thought on those new players, as well as, and how do you compare your service to them?
Well, first of all, what is it? Doug Lebda. He had LendingTree.com.
Yeah, LendingTree.
He's probably was the guy who started that aggregator, those people.
LendingTree,
Klub. Lengo.
Yeah.
All of those
Lendio.
things. All of those things. And here's what they do: is they get you on a website and you're looking for a loan.
Yeah.
And they're selling that information
to somebody else.
So how much that person's paying for it is the only question you have to ask. Okay. I can tell you that it could be anywhere from $300 to $1,000 per lead that they get if they close. If they're charging you X for the lead. If you get the lead, then there's another fee behind that.
Oh, okay.
Okay. So everything is a cost. Okay. Are they good or bad? You can make your own experience from that. What I tell people is this, this is a process that requires sometimes an actual person you can actually touch, feel, and get to. When you get into the call centers like the Rocket Mortgages, you got a 720 credit score and 10% down or whatever and a W-2 job, they'll probably do all right. But if you have any issues inside of your process, these people are not very good experts in that. They do not know how to navigate you through it. If you're a self-employed borrower, not a very good place to go because those people just don't know how to do it.
Possibly because the people who are sitting behind the scenes and are helping you, they probably are just not very experienced.
They're not very experienced and they're not getting paid very well. Okay. One of my favorite sayings in life is you pay for what you get. I mean, you really do. Sometimes you need, and you can pay me more and still get a better deal.
Right.
And I make more. But one of the things is if you're somebody who needs more experience because of the process and because of your credit situation, whatever you're going through,
you should be able to help them
navigate because that guy that's on the end of that telephone is only seeing X amount of information. Once that file gets to underwriting, I can't tell you how many loans come back to me that went to Rocket. Okay. It is a regular. I've had realtors say they won't deal with Rocket when they hear that their client has gone there. It's a niche market that, if it's an easy deal, they can handle it. If it gets anything complicated, they just can't do it. So what I think of aggregators is understand there's really a cost to that. What that cost is depends on, how you could compare it to something else. If you came to me and you got a quote from one of the aggregators and came to me, probably my rate might be better.
Okay. Again, I'm taking the example of Aryan. Aryan is 22-year-old graduate. He's getting into the market.
The guy over there?
The guy over there. So what would you advise for him in terms of prepping himself or educating himself before he gets into this world of mortgage, the fantastic world of mortgage? Number one, what would be the ongoing education that he must take? Anything that he must?
Well, first of all, you have to understand we are licensed. Okay, and there's a licensing process. You have to take a class to get there, and then you have to pass a test.
How long does it take?
Well, the course part of it is easy. It's only 24 hours.
Oh, is it? Okay.
Okay. It's 24 hours. That's why I said you don't need a college degree. No. But I will tell you, we have about a 55% failure rate on the test.
On the test.
Okay. Because the test gets way into things that has nothing to do with what you may actually do as a mortgage loan origination. Okay. It gets into servicing and all these other things and aspects. And what I call alphabet soup of regulations from FICRA to FCRA
Glossary,
and ECOA, ECOA, and Graham, Hartley Act. I mean, there's just all these things that you have to kind of get your mind into. So you got to be able to pass that test. And so you got to go into that, study for that, and understand how to get to that part. Once you're there,
right,
it's only 8 hours a year to
do the continuing at sea.
And then there may be some additionals for the states that you're in. And I highly recommend, even if you want to go to work for a bank, to get your mortgage license, because your ability to go to work somewhere else, the banks don't require you to have a license. But if you want to go to work as a broker at some point, you're going to have to get a license.
So who are some of those providers, license providers?
Well, there's a company called Deal that I work with, DIEHL. There's million, you can Google that up and it'll pop up. I'm working with another one right now for my continuing ed. I call that 8 hours of my life I don't get back, but there's also state specifics. Every state now has its own licensing. Gotcha. If you want to be licensed in 40 states, be prepared that you may have to spend a week in doing continuing ed every year, because like North and South Carolina require their own an hour each, in addition to the 8 hours there. So there's 10 hours. And if you got Georgia and Florida and whoever, some of them have pooled together and said, if you take these courses, we'll accept that. But it's all across the country.
So why would you take licenses in 40 states unless you really want to do like an online stuff?
Well, if you wanted to be in a call center, you'd really need to be licensed in a lot of places, because they're all over the place. I personally stay licensed in North and South Carolina because I sit on the border. I am able to now, because of where I'm at. If I get a loan in Florida, I have a broker down in Florida, one of our constituents, and all I have to do is pay them a part of my commission to do the loan down there, and not have to have the license there. So, there's ways around it, but the purpose would be, if you're going to be in the local market, you want to be able to access at least the states around you.
Interesting. Shifting a little bit of the gear, what's the future of the mortgage industry according to you?
Well, it's really interesting. They've been telling us for 30 years that they won't need us anymore. Okay. And they're still telling it, and we're still here.
Right.
And so what I see the future of the business is, as AI gets more into our industry in a bigger way, is how you market yourself in that world.
You still need that client facing.
Yes, you still have to have that situation. I do a lot more online banking than I used to. Every mortgage I ever took for years and years, that person sat in front of me and I took their application. That's all gone. Everybody does online applications. And there's something you lose in that process that I can get into, because when I interview somebody personally, I find out things that I know could be a potential problem in the future. You have to be able to aggregate through that. But the bottom line is everybody's doing everything online, but you still need that professional on the other side that understands how to walk you through some of the other intricacies.
So you become more enablers.
Yes. Okay. The other thing that I've been told for the last 20 years is we're going to have a paperless mortgage. I'm sorry.
20 years?
For 20 years, I've been listening to, we're going to have no paper. All I know is there's 50 more pieces of paper in that mortgage package now than there was 20 years ago. And I'm like, okay, now we're starting to get into where you can electronically sign some documents. Yeah. And when I say this is all the what I call disclosure documents that have really nothing to do other than they've told you that, hey, if you don't make your payment, we're going to report you to the credit bureau, or you can't you can't run a you can't have a meth lab in your house. You can't use your house for illegal activities. A lot of those things are being done electronically, but there's still documents such as the deed of trust, the mortgage itself, and like the closing disclosures. They want all those ink signed. So we're starting to aggregate down what we can do on an electronic basis, but it's still a ton of stuff.
Okay. So do you think with this technology and AI and other things that are coming up, Will you end up closing more deals than ever?
I think that you will give you the ability to handle more loans. It'll give our back office people the more efficiency in
Yeah.
that. Um, but to be honest with you, how much you want to close in this business is really how much do you want to work. Because I'm going to tell you something. We have people in this business that do $100 to $200 million a year.
One person?
One person.
Really?
Yes.
Or in terms of the deal size?
A deal of mortgage volume.
And how much that translate to your personal income?
Well, if you did $100 million, you're a 7-figure earner. Okay. I'm just telling you, that's one of the greatest things about, I told you this early on. Yeah. This is a business that you can make as much. Now, what I've learned and why I don't want to shift gears out, but what I do know is one of the things I wish to is this is real estate and mortgages transactional. When I say that, you close a deal, you're done. You got to go to the next one. If I were to change anything that I had done over the last 20 years, I would have gotten something that would create more residual income.
Yeah.
And so if I were changing something, there are some mortgage companies now and they use it as a hook to keep you with them. The question is how long do they last? But they will actually pay you a little piece of the servicing on the loan going forward, and there are a few companies that are doing that.
What does that mean?
Well, so for example, if you do a loan and the company does the servicing, in other words, and believe it or not, they don't hold the loan. That gets sold into the secondary, but you have to service the loan. You have to collect the payment, taxes, insurance, and send all it off to everybody every year. And that's worth something. Believe it or not, 0.3% of every mortgage goes to that.
Oh, really?
Okay. People don't know this, but a percentage of your mortgage goes to being able to do all that work on the backside of it. And what the companies have done is some companies is if you stay with them and they have the servicing and keep that servicing, you will get a little piece of that. And, if you stay with them long enough, well, that grows over time. Now, how much that grows to is, it could be $1,000, $2,000, $3,000 a month or whatever over time. But at least it's not as transactional.
Right. Okay. Got it. So what, in your opinion, is one thing that you would love the mortgage industry to improve?
I think I'd love for the mortgage industry, and this has a lot to do with government regulations. I would like to see us be more consistent in our regulatory base because it creates a tremendous amount of confusion in our compliance departments. And that's a back office thing. Okay. Everybody's got a different interpretation of what the Consumer Finance Protection Bureau wants from us. And I don't know if they do that on purpose or not, just to, I really don't. But there's a lot of confusion for compliance purposes. From another side of it is I just wish the industry would, make it, I've been hearing for years, mortgages are going to get easier. And I keep saying when, okay. And I just don't know, I understand, the stresses that Fannie Mae and Freddie Mac have put on all of the industry. Do you realize Fannie Mae and Freddie Mac will make you buy back a mortgage that's performing because they didn't like some document you had in there?
Okay.
As an industry,
they will make you
buy back? They will make our company buy back a mortgage.
How do you do that?
Well, for example, let's say one of our wholesalers closes a mortgage for us, and we put a document. They get a document in there like the gift funds, and they don't like the way the gift funds were sourced.
Structured.
Okay. Now the mortgage is performing, and it's but they'll say, hey, we want you to buy it back. Well, why would you buy back something that's not performing? That's performing.
Yeah.
That's the kind of stress that we have in our industry. It's making that process harder. I wish the backside of this would get off of that. Okay. Make it easy. That would make our ability to give you a mortgage easier, because that's why underwriters, and some of them are better than others. Some of them, I call them forensic, underwriters. I mean, I don't care what blood type they have. I really don't. But the truth is it has made underwriters very, very tough on us to get all the proper why do you want this? Because they live under that fear of, and let me explain something to you. When you start buying back $200,000 and $300,000 and $400,000 mortgages, that goes back into what they call your warehouse line, and then you have to turn around and sell that on what we call the scratch and dent market, and you might take a 10, 15, 20% hit to get rid of that mortgage out of your your warehouse line. You know, it doesn't take long for that kind of stuff to add up and hurt your bottom line. But I really, really wish that Fannie Mae and Freddie Mac and all of these agencies would just take some of that heat off of us, because it would make it so much easier for us to be able to navigate that consumer. And if I were to tell you the one thing I want to see happen, it's that the regulatory side of our industry. We are one of the most regulated industries on the planet.
Right.
You know, I mean, you can go down here and get those loans on your car for like, you know, a car loan, you know, a title loan.
Yeah.
You pay 30% interest. Nobody even bothers those people. They beat the hell out of me for loaning money to people at 6%. You know, I mean, that's kind of things that I don't understand. You know, why isn't that guy regulated more than me?
Right.
You know, and it's just, so I would hope that the regulatory side of this industry would lighten up loosen up. You know, you don't have to get crazy, but you can take some of that. Hey, if something's performing, don't bother it. You know,
why fix if it's
broken? You know, you know, if a loan's been performing for 12 months, it's going to perform. You know, there is an old saying in our business, though: a good loan can go bad, and a bad loan can get worse. But you know, but the truth is if they would help us on that side, it would help the consumer so much better.
Got it. Okay. So I have this very generic question. I think you touched upon this a little bit earlier. Let's say if I have a credit score of 680 and I'm paying X rate, whatever that rate is, and then there's someone who's got a credit score of 780, but they're paying a much better rate. I was told that I can buy the difference by paying some amount.
Yes.
Is that true?
Yes. Well, here's an example. They call them LLPAs. That stands for Loan Level Price Adjustments. Okay?
Loan level price adjustments.
Okay? And that's based on there's two factors. One is loan to value ratio, and the other is credit score. Okay? And believe it or not, putting 20% down doesn't always get you the best rate. Somebody at 10% down might get a better rate
because of the better score.
Because they're paying private mortgage insurance.
Okay.
And, you know, you may pay a little bit for that, but believe it or not, that's kind of thing that goes on. But let's just talk about credit scores. We start seeing today, and I've never seen this grid before, but it's 760 between 740 and 760, 720 and 740, 700, 720, and then 680 to 700. You go below 680 and you just pretty much have to put yourself at an FHA loan because the loan level pricing. But to your answer to your question is you have a 680 credit score, and let's just say the rate says 7%, okay, and you have to pay 2 points to get that, where the guy with 780 is going to pay no points.
No points. And what's the cost of the 2 points?
Well, whatever the loan amount is. Okay. For example, if it's 200,
2%.
It's going to be 2% of whatever you're borrowing.
Okay. Oh, wow.
So that what
goes into the mortgage itself, or
no? That goes directly to the investor that goes directly to Fannie Mae. Okay. That's what they're charging us to do that loan for you.
So, but am I paying from my pocket, or is it going from the loan amount?
No, you're paying that from your pocket.
Oh, really? Okay.
Yes.
So I have to pay that.
So, yeah, you know, so it's a $100,000 loan. It's $2,000, and you can just do the math after that. So, but you're going to pay $2,000 where that person with a 780 credit score might not pay anything at all. That's an example. That's not an exact example, but that is an example of what you're talking about.
Got it.
So therefore, you know, the importance of your credit score becomes very, very valuable to you in that aspect.
So what that tells me is that before you get to mortgage, because it's a high value thing that we're talking about, maybe fix your credit score if you have to fix it.
You do. And we have models inside of there. Can I tell you the number one driver of credit scores?
Revolving credit?
Yep. Okay. That's exactly how you use revolving credit. You know, installment payments you pay every month. As long as they're not late, they're not late.
Right.
But how you use and how we evaluate that is very different than the rest of the world. People come to me, well, you know, our algorithms are different. We don't actually pull credit reports directly from the agencies. We use we have credit agencies that we buy, that we use to pull our credit reports from. And they use the algorithms that are required from Fannie Mae and Freddie Mac. And how you use revolving credit is extremely, extremely instrumental in it. And it's just not, you've always heard if you have 30% of your available credit, you get a better credit score. But they're also looking at something else. Do you pay minimum payments or do you pay more than minimum payments?
Right.
It's actually evaluating all of that.
Both aspects.
Both aspects in there. And a lady came to me and she got upset with me. And, well, why is my credit score only 706? I just looked the other day and it was 752 or 732 or whatever it was that she pulled from whatever. They don't use the same thing we do, and it has a huge impact. There are things that people need to understand in regards to, do you realize if a collection hits your report, that's 80 points. Okay. Now, good news about medical collections now is if you pay them, they have to remove them completely.
Oh, is it? Okay.
Okay. That's a new law that's been recent. And so if you pay off medical, now, if you have a collection and you're trying to negotiate, I try to tell people, and you're trying to pay it, if you think you owe it and you really
pay it off.
Pay it off. No, negotiate to have it removed.
Oh, really? Okay.
I'll give you a little more money if you'll take that off the report, because here's what happens. You pay that off and it re-reports as being paid off. Well, it's just like if they just claimed it. It has the same impact on your credit score. Okay? So negotiating to have that removed is extremely important too.
Got it. Okay. That's great. So we are almost getting into our final section.
Sure.
I know you wanted to talk about the power of zero. So do you want to do it after this?
We can.
Okay.
We can.
Okay, let's just get into the rapid fire questions. So what's the most memorable mortgage deal that you have ever closed?
Well, believe it or not, it was mine recently on a piece of property that I bought out in Hilton Head, and it's a great example of having correct representation in the process. There's been a lot of stuff about paying realtors and things like this, and sellers and buyers. Right. The guy went cheap and used some company, tried to tell me that an assessment was due next year, found out it was due this year, and clearly stated in his contract that he had to pay it at closing, and cost him $11,000. So for my aspect, but really that's a memorable thing because it just happened. But I think one of the more memorable things I've done is for a lady who one of the most smartest people in the world, that we were able to get her a mortgage. She has a contract with the government, but she's an independent contractor, and I had to do a 12-month bank statement. And this woman has a degree in PhD in computer sciences. And she came to me and she said, "Ron, I don't know how you do what you do." And I looked at her and said, "Ma'am, you're the first person that's ever recognized that." So from a memorable standpoint, when you get somebody that really understands what they did for you and appreciate it, you have no idea what that means to us.
Yeah, you're grateful to them.
I'm always grateful to help anyone, but when they understand what you've done for them, that brings a lot to
satisfaction.
There's a great deal to the table on that.
Awesome. So what's the best piece of advice that you've ever received in your career, especially as a mortgage?
I will tell you, the best advice I ever got was in sales, about sales. And it was the word that will make you the most money. It's no. Because sometimes you have to tell people no, and you can't be afraid to do that.
Oh, yeah.
Everybody does not. No one wants to tell anybody no. Okay? And I'm just telling you, your life will be a lot better, and you'll make. And when you say no to somebody, you need to tell them why.
Yes.
Okay. A lot of people come to me and say, "Well, the bank turned me down," and I go, "Why?" "Well, they didn't tell me." Okay. Well, I'll open it up for them, and then I'll tell them why.
So they can fix it.
So they can
later.
fix it.
Yep.
Okay. So when you tell somebody no, tell them why, and help them say. And then the favorite thing is it's not no, it's not right now. Okay. Any way you want to put that, but don't be afraid to tell people the truth.
Yeah. So it opens up a lot more opportunities as well. So yes. I always say, and NO means new opportunity.
Yes, that's correct.
Yeah. Cool. Any book or podcast, we're going to talk about that you would recommend to anyone interested in finance or real estate?
I will tell you right now, that book right up there, The Power of Zero, is the most impactful book I have read. And I've read some more since then, but that right now for everybody.
Do you want to bring that book and we just show it?
To everybody? And this has nothing to do with mortgages. It has to do with a lot of different things. But from a financial standpoint, this is the most impactful book anybody can read right now to understand what they need to do about how how you're saving for your retirement. Okay.
It's cool.
And I just think this is it. As far as books that you could read, there are so many good sales books out there that people read. I mean, Steve probably has more of them than I do.
Right.
There are great sales books that you need to understand. You know, believe it or not, sales is a huge part of our industry, as I had indicated at the front end of this.
Cool.
You know.
Yeah, I mean, I read that book. It's pretty good. You know.
You know what? And I hate to say this, and we're going to change gears a little bit, but I'm just saying it like it is. We got lied to for the last 50 years on how to save for our retirement.
Right.
And it seemed like a good idea. And I understand why the corporations bought into it. They found out they didn't have to manage pension funds anymore. You know, it was like, oh, God, you mean I don't have to do that? But I really think this is an impactful thing. The number one expense that people are going to face in retirement, you know what it is? Taxes. Taxes. And people say, well, you're going to pay less taxes when you retire. I said, do you want to live in poverty? Because that's the only way you're going to live. You know,
right.
If you retire at 80% of your current income, well, how much marginally does that change your tax structure? Not much. Okay. So if you're wanting to live where you are right now, you need to understand where your tax liability is going to come from.
Cool. So if you could go back and give yourself one piece of career advice, yourself, not somebody else, what would that be?
Be more humble in your life and understanding what people's dynamics are. Understanding that. There was a lot of lessons. The one I told it to you earlier, understanding that people's perceptions are their reality. That is the number one advice I wish I had gotten 20 years before I realized it, because it makes your life a lot easier to understand how to help people.
Makes sense.
You know, you have to ask questions about what's going on, and if you're in this industry, the best piece of advice I'll give you is look at what is the worst thing that can happen to you inside that loan. Not the best, but the worst. What is going to get you through this process? And if you see it and address it early, you can fix it. Don't look at it as the most rosy, because I guarantee you the underwriter is going to look at it that way.
Sure. Again, this is not a part of the rapid fire, but something that just came to my mind. If somebody who gets into this field wants to earn a few $1 million, not I know as an individual contributor, you may be able to get to a high 6-figure or a high 7-figure per year, right? So what if they want to earn in millions? How do they go about doing it?
Well, if you want to earn, and there are people that have earned millions doing this, is you have to really create a team around you that can, a great team.
Just like any other business.
Okay. We had, I'm going to tell you, there's a company, Guaranteed Rate. During a few years back, they had 2 offices in Boston that both of them did $1 billion each
in the transactions,
in mortgage volume. Okay. And I don't want to tell you what that would take in terms of loan size and all the things that go into it. But, that is a team of people. And if you put together the right team, you can do it. Guy I work with, he's a great example. He's a younger man than me. I'm at a different point in my career. But he is a machine in his own right. And now he's assembling a team around him of people that do. He is the rainmaker. He's the guy that goes out and makes the rain. And then he's got his team around him. And he's kind of building himself back up to that. He made $1 million a few years ago in 1 year. Okay. So you've got to be able to you've got to have the right team around you. There are people that just don't want to do that. Okay.
It's satisfied with
whatever, you can pay them a piece of whatever you want to do that, to do the back end work for you. But if you create the right team, you can make several $1 million a year in this. I can just tell you those guys made a bunch of money. I'm talking 10, 12, $13 million in 1 year. Okay. So that's what I would tell you.
Any last piece of advice or thought that you want to give our audience, to the young crowd or small business owners?
I will tell anybody, today is, what is today? Is it another day or is it the first day? It's never, ever too late to get started. I'm a great example of it. You see this book? I kind of started a new career because of it. And I'm not going to, You may know how old I am. You may not know how old I am, but I will turn 70 next year.
Wow.
Okay.
Congratulations.
You know, my favorite joke is 69 is not supposed to look this good, but I find myself at a point in my life, and that I'm like, I'm excited. Why aren't you retiring? Because I don't want to retire.
Right.
I got a 15-year-old daughter to take care of, but I just like doing what I do. I love talking to people like you, the business club. That's what I love doing. And that's the last thing. Find what you love to do, and get everybody else around you to do the other stuff.
And then make money while doing it.
Yes, and make money while doing it. But
that's exactly what Steve talks about, Ikigai.
Yeah, the Ikigai. I don't know if you've ever heard of Brian Tracy.
Yeah.
Brian Tracy used to say, "What is your cost per hour? If you're mowing the lawn, why would you mow the lawn if you can hire somebody to mow your lawn? Right. Do the things you like to do, and hire other people to do the things you don't like to do.
Right, exactly right.
Stay in your zone and do what it is that makes you the money. So that's it.
Cool. Anything else that you want to say?
Like I said, it is never too late.
God.
I mean, it really isn't. And maybe I'm a good example of that. It's never too late. It's funny. Steve and I have two different philosophies. Yeah. I love Steve. But Steve says, what do you want to do different in your life? And he doesn't want to do anything different. He loves where he is. And if you're there, that's great.
Right.
But I'm not. I'm continually wanting to learn more and change. And I think that's what makes life dynamic and keeps you alive. I don't know how long I'm going to live, but I plan on living whatever it is. I plan on living it to the fullest of my abilities. So.
Great. So, Ronnie, thanks for coming.
I appreciate. I really, it's an honor to have you do this with me. I love kind of doing stuff like this anyway, but look forward to it, and great success with the business club. I really am looking forward to building the business club, because I love the concept of it. We've all done a lot of things in that world, and I will be honest with you, this is one of the best I've come across. So thank you for putting that together.
Yeah. It's an honor, and it's a privilege to have you here.
Thank you.
Yeah. Look forward to having many such conversations.
Well, the next one will be about this. How about that? Okay?
Yeah, sure. Right. Sounds good.
Take care.
Yeah, we'll do a Power of Zero special.
Yeah, we will. Let's do that.
Cool.
All right.
Sounds good. Hey guys, I hope you really liked the video, and if you did, please like, subscribe, and comment. And we would like to reach many more small business owners. I would really appreciate if you can share the video with them as well. Thank you, and see you until next time. Have a great one.